we've been hearing about a divergence in monetary policy around the world, with the U.S. experiencing some growth and increase in rate hikes, while other economies are still focused on further easing. What's Vanguard's view on all of this?
Well, I'd say that I think, broadly, this notion of policy divergence, Noni, in our opinion, is just a misnomer. Clearly, the U.S., and this was, our view going back for more than a year, the U.S. was going to be, and likely continue to be, the only major central bank to be raising rates. We would have included the U.K., but clearly with the recent events in Brexit, that's off the table. But I think there's a lot of hand-wringing in the sense of the U.S., that the Federal Reserve may be raising rates, the ECB and the Bank of Japan in negative territory and potentially pressed to go further, that's somehow both profound and extremely distortionary going forward. I'd say when we've taken a step back and we've looked at historically, first of all, there's been great, much more market differes between where the U.S. short-term interest rate is and those of Europe and Japan, much more so in the past than it is today. The actual thing what's profound is that everyone is close to zero, at or below or slightly above zero. That's the profound. So if anything, there's been a convergence and monetary policy, which I think speaks to the global conditions we're in, with still some deflationary bias in the world from China, growth that on a cyclical basis still could be a little bit stronger in some areas of the world. So it's that context. So when we hear divergence, we say, well, divergence with respect to what? Relative to history, where the average difference has been 300 or 400 basis points, today they're actually trivial. I think the profound moment in history that we sit in is actually convergence in central bank policy. And I would also argue that I think central bank is increasingly at its limits. If policymakers, by and large, want to have a greater cyclical thrust on the economy, I think central banks have to start. I think they've earned the right to kind of push back to their fellow policymaking peers and start thinking about, fiscal policy with respect to either infrastructure spending or, more importantly, for every major economy. I think there's some structural reforms that may not show up in the GDP numbers for this year, but could very well have a longer-term boost to various economies around the world. So I think we're going to hear more of that because I think we do. I'm personally of the view that negative interest rates are a mistake. And I think history will show that with the lack of any sort of strong boost to economic growth. But all this is in the context that this notion of divergence in our mind is a misnomer, and it's really around a convergence towards zero. And what's next? I think we will need to see, potentially pairing of other levers from policymakers writ large if we're going to see, stronger growth at the margin.